So Stanley Black Decker just dropped their latest earnings, and wow, what a confusing report. I mean, the headline numbers were all over the map. The stock got hammered at first, only to stage this huge comeback. So what did the market miss right at the open? Well, that's what we're going to dig into. We'll break down that head fake and show you the real story that was hiding just under the surface.
Okay, so right away, here's the problem that threw everyone for a loop. On one side, you have revenue coming in at $3.68 billion, a clear miss. That screams slowing demand, right? But then, on the other side, their adjusted earnings per share, a solid beat at $1.41. This is the classic investor dilemma. A weak top line, but a strong bottom line. It really forces you to ask, which one matters more?
And you could see that confusion plain as day in the stock price. I mean, look at this. In the pre-market, as people are just reacting to that revenue miss, the stock's down about 2.4%. But then, by the end of the day, it completely flips and closes up over 4.5% on some pretty heavy volume. So the big question is, what on earth did the market figure out between the opening and closing bells?
To really get why the stock rallied so hard, we first have to understand why it dropped in the first place. And look, the sellers, they weren't crazy. There were some very real concerns in those headline numbers, and especially in the company's forecast for the future.
So yeah, that earnings beat of almost 10% was nice, for sure, but the market's initial focus was lasered in on that 2.2% revenue miss. You have to remember, in this kind of economic environment, investors are super sensitive to any sign that sales are slowing down, and that weakness right at the top was the number that sent the first wave of sellers running for the exits.
And the CEO, Chris Nelson, he didn't try to hide it. He got right on the call and said, yep, revenue was below what even we were expecting. And the reason? A pretty big 7% drop in volume. That decline completely wiped out the gains they made from raising prices. This volume pressure, especially in their main tools and outdoor business, was the big red flag for anyone bearish on the stock.
And then came part two of the problem. The guidance. When management laid out their forecast for the full year, their earnings per share number came in way below what analysts were hoping for. So now you've got this double whammy, right? A miss on sales right now and a soft guide for earnings in the future. Normally, that's a recipe for a really, really bad day, but not this time.
Okay, so let's get to the pivot. This is where things get interesting. As the earnings call went on and analysts started really digging into the numbers, a completely different story started to come out. A much more powerful, positive story, all about incredible execution and some really smart money moves.
And here is where that story really starts to turn. Their adjusted gross margin, it expanded by a massive 210 basis points. Now, this wasn't just a tiny little beat. This was a giant flashing sign that management strategy is absolutely working. Through disciplined pricing and some serious cost cutting, they proved they can boost profitability in a huge way, even when sales volumes are down.
And then came the cash. The company churned out an incredible $883 million in free cash flow just in this quarter. I mean, that is a huge signal of operational health. It shows they're managing everything super efficiently, and it proves that the earnings they're reporting are high quality. You know the saying, cash is king, and Stanley just printed a ton of it.
And this was the kicker. The big announcement that they're selling off their aerospace manufacturing business for $1.8 billion in cash to pay down debt. This is a total game changer for their balance sheet. It takes so much risk off the table, it lowers their debt load, and it just gives them incredible financial flexibility from here on out. So now, with the market suddenly focused on all these huge positives, all the attention shifted to the Q&A part of the conference call. This was the moment of truth. Management had to prove they could actually handle the future challenges they had just warned everyone about.
And you know what? They absolutely delivered. They confirmed their plan to deal with tariffs is actually ahead of schedule. They talked about how they're making surgical tweaks to promotions, not just slashing prices everywhere. And crucially, they pointed out that the professional market, the contractors and pros, is still really strong, and that's helping to balance out some of the weakness from everyday consumers. Finally, they were transparent, telling the market to expect a bumpy Q1 before things get better, which gave their whole outlook a ton of credibility.
All right, so let's put it all together. You've got the weak sales numbers, but you've got this stellar execution underneath, plus a huge strategic move to clean up the balance sheet. What does it all mean for the stock going forward? Well, that brings us to our take on the whole thing.
So here it is, we're initiating our coverage with an outperform rating and setting a price target of $105. The key things to watch for, the catalysts, are actually pretty simple. First, we're looking for them to keep surprising us with how well they execute on margins. Second, we need to see that $1.8 billion deal close smoothly and on time. And third, we'll be watching to see how fast they use that cash to pay down debt and make their financials even stronger.
So with that in mind, what's the actual actionable trade idea here? How could you position yourself if you believe this story is going to play out?
We're calling this one the execution premium trade. And the thesis is pretty straightforward. We think that even after that one-day rally, the market is still underestimating just how fast and how impactful this operational turnaround is. So the setup is to go long the stock, but in your own financial model, you'd pull forward their 35% margin target by one full quarter. And the payoff? Well, if they hit that target early, it's going to lead to a significant earnings beat that the rest of the street just isn't expecting, forcing a total re-rating of the stock as everyone realizes this is a leaner, meaner, and fundamentally transformed company.
So, at the end of the day, while the headline numbers told a really confusing story, what was happening underneath was a powerful story of great execution. It's just a great reminder that sometimes you really have to look past all the noise to find the real signal. This is not financial advice.